Please stay tuned for important disclosure information at the conclusion of this episode. Welcome to the Investing Insights podcast from Morningstar. In this week's podcast, we reveal what stock was the high conviction purchase for 5 of our favorite managers. Ben Johnson discusses the tax efficiency of ETFs. Christine Benz encourages investors to consider direct giving. Tim Steffen shares tax strategies for retirees. And Tom Whitelaw shows investors how to assess liquidity. Let's get started. Here's the one stock top managers can't get enough of.
Each quarter, we take a look at the recent transactions of some of the top money managers around today, who we call our ultimate stock pickers. Last quarter, one stock was a high conviction purchase for 5 of our favorite managers. What's considered a high conviction purchase? A high conviction purchase is one that makes a meaningful addition to a portfolio, as measured by the size of the purchase in relation to the size of the portfolio. The managers at Vanguard Dividend Growth, American Funds American Mutual, Columbia Dividend Income, Parnassus Core Equity, and T. Rowe Price Blue Chip Growth all made meaningful purchases of Apple last quarter. At Morningstar, we think Apple has carved out a narrow economic moat, and we think the moat is stable. Apple's competitive advantage stems from its ability to package hardware, software, services, and third-party applications into sleek, intuitive, and appealing devices. This expertise enables the firm to capture a premium on its hardware, unlike most of its peers. However, given the short product cycles of Apple's products, an army of firms targeting its dominance, we do not believe Apple has a wide economic moat. We recently raised our fair value estimate to $85 per share from $71, as we incorporated a stronger near-term outlook for the Mac and iPad segments due to ongoing work and learning from home dynamics. Nonetheless, we think shares are currently overvalued, as we think recent growth trends could be unsustainable as we enter 2021.
6 days a week, we deliver the latest news for investors. Just say, Alexa, enable the Morningstar skill, or visit morningstar.com/Alexa. Now, Ben Johnson from Morningstar Research Services talks ETFs with Susan Jabinski from Morningstar, Inc.
Hi, I'm Susan Jabinski with Morningstar. Exchange-traded funds tend to be more tax efficient than mutual funds because they generally distribute smaller and fewer capital gains. But that doesn't mean that ETFs are tax immune. Joining me to discuss how the capital gains distribution season is looking for ETF investors this year is Ben Johnson. Ben's Morningstar's Global Director of ETF Research. Hi, thanks for being here today, Ben.
Thanks for having me, Susan.
So before we get into some of the specifics, let's take a step back and let's talk a little bit about what really makes ETFs in general more tax efficient than mutual funds.
Well, Susan, ETFs' tax efficiency is really rooted in their structure and the way specifically that money moves into and out of ETFs, which is in stark contrast as to how it moves into and out of traditional mutual funds. So most investors are probably familiar with the cash in, cash out proposition that is a standard open-ended mutual fund. I, as an investor who wants to invest in your mutual fund, will fork over cash. That cash will go to the fund. The fund will take in the cash. The portfolio manager will put that cash to work for me as a new investor in that fund. We'll invest in a variety of different securities, stocks, bonds, you name it. When I want my money back, I call up the mutual fund company again and say, I need that money. I've got to fund whatever it is, what my goal was for that money, or I want to take my money up. I'm a dissatisfied customer and move elsewhere with it. So the portfolio manager has to go back to the market, has to liquidate those securities, and has to deliver that cash back over to me as an investor. Now, there are costs involved in that cash in, cash out transaction when it comes to going into the market and transacting in those securities. There may be brokerage costs, there may be market impact. Coming out, what we've seen in recent years is one of the most prevalent, one of the most pernicious costs has been tax costs to taxable investors. So the departure of many a shareholder from many an open-ended mutual fund has forced those managers to sell securities that have appreciated in price relative to their cost basis. And in the course of doing so, they're unlocking taxable capital gains that are not just the problem of those that are leaving the fund, but people who are sitting tight and loyal fund shareholders. Now, ETFs are structured differently as opposed to cash in, cash out. What you can see is you've got some optionality if you're a portfolio manager. Specifically, you can bring securities into the fund on an in-kind basis. So you can work with a third party called an authorized participant, which is a special sort of class of market maker that picks up a basket of the portfolio securities, delivers that to the asset manager, and in return gets new shares of that ETF to meet new demand from investors. When demand is lower than supply, there's too many ETF shares on the market, the process works in reverse. So that authorized participant comes back with ETF shares and gets securities in return. So in that process, through in-kind creation and in-kind redemption, securities in, securities out, you're not creating any of these negative externalities, to borrow a term from economics. None of this friction, none of these nasty year-end tax surprises, at least not to the same extent, at least not with the same frequency as you see in open-ended mutual funds.
Now, that being said, ETFs can make capital gains distributions and sometimes do. So what have we sort of seen this year from some of the asset managers from a distribution standpoint?
That's exactly right, Susan. So it's important, as you alluded to at the onset, not to equate ETFs' superior tax efficiency with tax impunity. So income distributions, for example, are going to be taxed if you're investing in ETFs in a taxable setting. And ETFs are not immune from taxable capital gains distributions. We've seen that for years, and we see that again this year. That said, given all those structural advantages that I just described, what we see is that taxable capital gains distributions in ETFs tend to be less frequent, and they tend to be smaller in magnitude relative to what we see in open-ended mutual funds, and that's thus far proving to be the case again in 2020. So as of today, what we've seen is that 9 of the 15 largest ETF sponsors have reported on what they expect from their funds in terms of taxable capital gains distributions. Now, collectively, those 15 firms have 789 ETFs, and just 55 of those, so about 7%, give or take, are expected to pay out any taxable capital gains. And for the most part, what we see is that among those 55 ETFs that are going to distribute taxable capital gains, for the most part, they're going to be pretty small in the neighborhood of 0.02% to call it 0.5% of their underlying net asset value.
And is that about standard? Is this where it sort of has been this time of year, in past years?
It's in line with trend. It's a shade higher, actually, if you look back to the past 2 years. So in 2019 and 2018, roughly 5.5% of that same universe of funds paid out any form of taxable capital gains distribution. So it's ticked up, but ever so slightly.
And are there any particular factors that are driving the distributions this year?
Well, part of the reason that we've seen this uptick is what's been going on in fixed income markets. So of those 55 ETFs that are slated to distribute taxable capital gains this year, 49 of them are fixed income ETFs. And there's really a confluence of factors that explains why those funds are going to be distributing gains. Part of it just has to do with the way that some of them are structured. So they might own a very specific segment of the fixed income market, say intermediate term bonds. And if I'm carving out that specific segment and I'm an index fund, that means that once an intermediate term bond crosses the border between intermediate and short term, I have to liquidate that position. It's going to roll over into a different portfolio. And what we've seen in fixed income markets is that generally this year, rates have gone higher, or rates have gone lower, I should say, which has pushed bond prices higher. So many of those positions that are rolling out of, say, intermediate term and into short term are appreciated positions now. So the portfolio manager is having to liquidate those absent any opportunity to purge them from the portfolio in kind and realizing gains in the process, which is the other issue that we see at play this year, is that those opportunities to take those securities out of the portfolio on an in-kind basis have been fewer and further between. This has been a boom year for bond ETFs. Thus far this year, we've seen record flows into fixed income ETFs as a category. And when flows are all going one way, they're all going into these funds, that gives fewer opportunities to send securities that have low cost basis out the other end. So this, in-kind creation redemption, it's almost a form of like a tax dialysis of sorts for fixed income ETFs, for all ETFs portfolios, and that requires kind of a regular cycle, a regular churn in the form of not just inflows but also outflows, and those outflows are what creates the opportunity to get lower basis security out of the portfolio. New inflows then can add higher basis securities into the portfolio and raise the overall cost basis of that particular ETF. So as bond ETFs have been having a terrific year in terms of inflows, there's just been fewer opportunities to kick those low cost tax lots out the door.
Interesting. But it still sounds like, Ben, still terribly tax efficient in general this year, even though there might be a slight uptick.
That's absolutely the case. So I wouldn't take what we've seen this year as any indication of some sort of a fatal structural flaw or some scary breach in the tax efficiency proposition of the ETF as a vehicle. I think it's held really quite well, even in the case of fixed income ETFs, where we've seen a slight uptick in gains. Again, those distributions have been small, and just 6 now equity ETFs have distributed or will distribute, based on what we've seen reported to date, any taxable capital gains. So, the tax proposition there from a taxable investor's point of view, I think remains as solid as ever.
That's great. Well, thank you so much for walking us through the landscape today, Ben. We appreciate your time.
I'm happy to join. Thanks for having me, Susan.
I'm Susan Jabinsky with Morningstar. Thanks for tuning in.
Watch all the Morningstar content you love from your living room. Download the Morningstar Roku channel and get up-to-date independent insights on today's markets. Be comfortable. Be informed.
Next, Christine Benz from Morningstar Inc. suggests another type of gift during the holiday season.
Hi, I'm Susan Jabinsky with Morningstar. This time of year, many investors make charitable contributions, in part to enjoy their tax benefits. But Morningstar's Christine Benz suggests that we think about making another type of gift during this season of need, the direct gift. Christine's here with us today to talk about this strategy. Nice to see you, Christine.
Susan, it's great to be here.
Now, so let's talk about this strategy, which is essentially giving a direct gift to someone who is in need. Can you give us an example of that?
Yeah, I think, many of us do know someone who's in need right now, whether they're in need of basic living expenses to cover rent or to cover food costs, or maybe they, are struggling with credit card bills or some expenditure that they'd really like to make to enhance their quality of life. So the idea is, just to spend a little bit of time listening to your friends and family members, people who do work for you in your life, in your house, find out what they have going on. And I'm guessing that if you listen closely, you're apt to identify at least a couple of areas where you may be able to help, assuming that you're lucky enough to be a financially well person yourself.
Now, you're not necessarily suggesting that you pursue the direct gift route instead of giving to charity, right?
Absolutely not. I think that you should do both if you possibly can. And the reason is that charities can just be tremendously efficient in terms of getting funds, getting goods out to people and entities who need it. So, to use a simple example, the Greater Chicago Food Depository is going to be much more efficient in purchasing food in bulk and getting it to families and people who need it versus me going to my local grocery store and stocking up my cart and, paying retail prices for that food. So definitely think about this as kind of an add-on. If you're a charitable giver through traditional means, this is maybe something to think about doing in addition to that sort of giving.
Now, the idea of reaching out directly to someone who who may have a financial need right now does seem a little awkward maybe for some people. How would you broach that conversation? Where do you start?
Yeah, I think it does get back to listening, Susan, to really spending time listening to what people close to you have going on in their lives. And I'll say I've done this a little bit in my own life. My husband and I have. And I think the key is, just to find a shared point of connection that can often be a really great way to offer some type of assistance like this. So, for example, I'm an animal lover. I have always people in my life who are animal lovers. And, an example would be if you have a friend who's struggling with a big surgery that she'd like to get for her dog to enhance the pet's quality of life. That might be a spot where you say, would it help if I helped with that surgery? Or maybe you have a child who participates in an expensive activity. Other parents who may be struggling with paying for that activity, but they'd really like to keep their kids engaged. That might be another spot, if it's someone you know well, certainly, to be able to say, can we help cover this round of activities this time? I know what you're going through. So I think just, spending time with people, listening to them, getting to know what their needs are, I would say that would probably provide a natural entry point for a lot of people.
Now, a natural question someone might have who would like to pursue this is, how do I make this financial gift to someone without feeling like that I'm going to become a source of ongoing cash for this person?
Yeah, I think that might be a pushback that some people might have to this strategy. And so I do think that coming in with a specific and prescribed gift is really a way to avoid that, to say, I will help you with this specific thing. And then another point I would make, Susan, is that no one should go into a strategy like this without knowing how to say no. So if it turns out that there are future asks which go above and beyond what you're willing to give, you really should be able to say, no, I'm sorry, that was all the help I could provide right now. So know your limits going into this sort of situation before you even offer, because it is an important point.
And just to be clear, there are no tax benefits to the giver in a situation like this. That's right.
That's right. So unless it's a qualified charity where you can make a tax deductible contribution, you wouldn't be able to earn any sort of tax break. The big benefit, though, Susan, the one we haven't really discussed, is that you can make an impact and help someone who is close to you, and you can observe the impact that you're making. And I think that can be tremendously gratifying as a giver.
Christine, thank you so much for exploring this really fresh idea to giving, and that seems especially useful this year. Thank you for your time.
Thank you, Susan.
I'm Susan Jabinski with Morningstar. Thank you for tuning in.
Now, Tim Steffen of PIMCO shares year-end tax tips for retirees.
Hi, I'm Christine Benz from Morningstar. We're coming into the home stretch of 2020, and that gives retirees a little bit more time to improve their tax position for the year. Joining me to share some strategies on that front is Tim Steffen. He's Advisor Education Senior Consultant for PIMCO. Tim, thank you for being here.
Thanks, Christine.
We have this hiatus on required minimum distributions for 2020. Let's talk about what had been sort of a vexing question for some investors who took their RMDs early. What are their options if they want to get the money back into the account?
Yeah, so whenever you take money out of an IRA, you always have a 60-day window in which you can return that money to the account, assuming you hadn't previously done one of those 60-day rollovers in the prior year. So if you haven't done one of those in the past, you've always got a 60-day period to put that money back. Because the rules on waiving RMDs came out a little bit later in the year, and many people were already past that 60-day window, they did offer a kind of a blanket extension for everyone to be able to put the money back. That expired, I believe, at the end of August. So that window has also passed. So if you're somebody who took money out of an IRA and you didn't get it back during one of those windows, then you may still have one option left to be able to return that. And again, this is something that came out of the CARES Act earlier this year. It's called a coronavirus-related distribution. And basically what that is, it's an opportunity to take money out of an account penalty-free and be able to spread the income over up to 3 years, or either tax it all in the current year or tax it in equal parts over 2020, 21, and 22. But then the relevant part here in this case is that you can also return that money back to the IRA as long as you do so within 3 years of the date that you took it out. So people who took money out of their IRAs earlier this year anticipating RMDs, didn't get it back in time for any of the other deadlines, may qualify for this coronavirus-related distribution rule, which would allow them to put the money back. It's not a blanket thing. You have to have been somebody who was impacted by the virus. You were sick, a family member was sick, your business shut down, you lost your job, your kids couldn't go to school, you lost daycare, something like that. There's a number of exceptions, and they're fairly loose, it appears. But that may be an option for somebody who wants to put money back into the retirement account that didn't do it earlier in the year.
Okay, good to know. Many retirees do find themselves, because there aren't any required minimum distributions, in what may be a temporarily low tax bracket for 2020. What strategies should they be considering to potentially take advantage of that?
Yeah, right. So this may turn out to be a lower year for people who weren't forced to take money out of their RMD, out of their IRAs, and therefore didn't take it. Some people may have still taken money out because they needed it to live on. It just wasn't an RMD this year. But if you were somebody who didn't need to, so you didn't need the money, so you didn't take anything out, yeah, this could be a relatively lower income year for you. So take advantage of that. That's an opportunity for you to maybe do some extra planning. A couple things you would consider would be pushing some deductions out of this year into a year when they might be taxed or provide you a larger tax benefit. We can talk more about some of that in a bit. But the other opportunity that's out there is you're in a low bracket. Take advantage of being in that low bracket. Who knows when you'll be back in there again? Maybe recognize some additional income. That might mean you have the opportunity to recognize some capital gains at a lower tax rate than you might ordinarily, maybe even as low as the 0% that's out there. The other thing that people are considering is Roth conversions. Roth conversions have gotten a lot of talk this year because of some provisions that came out of the Secure Act and some other things that have made them a little bit more attractive. But they really make a lot of sense in years when your income is artificially low. In other words, lower than it might be in a normal year. And you can take advantage of doing a conversion at a lower tax rate. So that'd be a real strong one for people to consider that want to take advantage of these lower income years.
Good to know. Now let's talk about the qualified charitable distribution. Mm-hmm. That is still an option in 2020, even though there aren't any required minimum distributions. And in the past, those two things have kind of gone hand in hand. Can you walk us through that and when you might consider that QCD, even though you don't have to take a required minimum distribution?
So let's just do a quick explanation of what the qualified charitable distribution is. This is that rule that came out several years ago that allows people to take money directly from an IRA and transfer it to a charity. You don't give it to yourself and then to the charity. You don't reimburse yourself for gifts you previously made. It goes right from the IRA to the charity. And when that happens, you don't have to report that as a withdrawal from the IRA. You don't get a tax deduction for that gift either, but based on some of the newer tax laws, very few people itemize their deductions anyway. So you might not have been getting a benefit for that charitable gift to begin with. But the money goes directly from the IRA to charity. And then it's a couple of the benefits are, we talked about it's not taxable. It can also count towards your required minimum distribution for the year. So those who were subject to RMDs could take the money out and have that count as their RMD. Now, a couple of big things that have changed on that. One is the RMD age was moved up to 72. That was a change in the Secure Act from last year that did not impact qualified charitable distributions. Those can still be made once somebody turns 70 and a half. Important note, it has to be after you turn 70 and a half, not the year you turn 70 and a half, but after that day. So you can still do a qualified charitable distribution even if you're under the RMD age. The other thing is, you said, though, there are no RMDs this year. So if there's no RMD, does it make sense to do a qualified charitable distribution? I would say in some cases, yes, it might. For example, if you're somebody who doesn't itemize, you want to give money to charity, but you're not somebody who takes the itemized deduction, you're going to use the standard deduction. Well, in that case, you don't get a tax benefit for your charitable gifts. So a qualified charitable distribution is a way to move some money out of the IRA on a tax-free basis. So maybe take advantage of that. The other group that might benefit from doing a QCD would be kind of the opposite of that first group. These are people who give a lot of money to charity and are exceeding some of the thresholds on deducting. Remember, you can only deduct or only offset a certain percentage of your income with charitable gifts, depending on what you give. Somebody who's over those thresholds could maybe use the qualified charitable distribution to move even more money out of their IRA to charity. So that can be a great opportunity for folks to still get some tax benefit for their charitable gifts when they might not have otherwise done so. And the fact there's no RMD this year doesn't mean you can't do it. It's still a great opportunity for some folks.
Okay, good to know. The last thing I want to cover with you, Tim, is estate planning. What kinds of things should be on retirees' radar as they're thinking through their estate plans, which often go hand in hand with tax planning considerations?
Sure. Well, as we get to year end, the one that always pops to mind is the annual gift exclusion. That amount is $15,000 this year. So that's the amount that any individual can give to any other individual with no tax consequences at all. It's $15,000 this year. We just found out it's going to be $15,000 again for 2021. So no change in that amount over these 2 years. Another thing to think about as we get towards year end, and this is a direct result of what came out of the Secure Act about a year ago, is review your beneficiary designations. The impact on beneficiaries of retirement accounts, the rules there have changed dramatically. So it's really important you understand exactly who the beneficiaries are in your retirement plans, because their ability to access that money during retirement has changed. You want to avoid things like will or estate or having no beneficiary, or maybe you've got a beneficiary, but you don't have a successor. So all those things are important. Review your beneficiary designations on your retirement accounts, plus your life insurance and anything else, your transfer and death accounts, all those should be reviewed. It's a good time to look at all other aspects of your estate plan as well. Take a look at things like powers of attorney, living wills, healthcare directives, especially important this year with all the talk about illness and flu and all that. Really make sure your healthcare directives are up to date and current with your family situation, where you live, all of those kind of things. And then, of course, we've got the potential for maybe some law changes coming in next year. Under the Biden administration, there's been talk about some fairly significant changes to the estate tax rules, a dramatic lowering of the lifetime exemption. Currently, it's roughly $11.5 million per person. There's been talk that might fall to as low as $3.5 million. Plus, the tax rate could go from 40% up to as high as 45%. And maybe we lose the basis adjustment at death that we've all come to rely on for wiping those capital gains out upon the death of an investor. So there's a lot of things that are on the table that could happen next year. A lot of uncertainty as to whether any of those are going to happen. So when it comes to estate planning, what I tell folks is, take care of some of the basic blocking and tackling, the gifting, the beneficiary designations. The big things, really think carefully about that because of the uncertainty with the estate tax law changes. You don't want to do anything that's too permanent that you can't undo, because we don't know exactly what the rules are going to be in the future. So be aware of them, talk to your estate attorney, get their take on things, and then figure out what makes sense for you. Maybe you kind of find a nice strategy in the middle somewhere that lets you take advantage of some potential changes without being too big of a commitment on your side. But definitely worth taking a look at.
Tim, always great advice. Thank you so much for taking the time to be here with us.
Thanks, Christine. Always great to see you.
Thanks for watching. I'm Christine Benz for Morningstar.
Lastly, Holly Black and Tom Whitelaw from Morningstar UK break down liquidity and investing.
Welcome to Morningstar. I'm Holly Black. With me is Tom Whitelaw. He's Director of Equity Strategies at Morningstar. Hello.
Hi, thanks for having me, Holly.
So, Tom, you've been doing some research into liquidity. I'm going to start with a really obvious question. What is liquidity in investing?
Yeah, so it's the ability to sell something in the desired quantity without impacting the price. And that price impact is key, as anything is liquid as long as you're not bothered about the price that you get. And it's why we talk about discount risk. That is, how likely is it that I will have to take a discount on the market value of my investments if I want to sell them?
So how do you assess that discount risk?
It's not easy because it's a fluid concept. So 1 minute liquidity is plentiful and then the next it's not. So we look to build up a picture of the fund from all of its individual stocks. And we look at the liquidity of those stocks across a number of ways. So we look at here and now, how liquid is it today? And then also how liquid has it been at the worst case scenarios? And we look at that on a couple of levels. We look at it on a pro rata style sell down, which is selling everything in and keeping the portfolio structure exactly the same. So if I've got 5% BP, 3% Vodafone, when I've finished selling, I've got 5% BP, 3% Vodafone. And also a waterfall sell down, which is more like a fire sale sell down. So in that scenario, maybe BP and Vodafone are my most liquid and I end up with 0% in there. And we weight it towards the pro rata because that's what we think is more typical. And the final thing we look at is company ownership. So how big a chunk of individual companies am I owning? Because if you're owning 5, 10, 15, 20% of individual companies, it's much, much harder to sell those weights.
So that's all good as an analyst for you, but if I am an individual investor, I buy and hold for the long term, do I still need to worry about liquidity?
Well, I guess the very worst case scenario you can have of owning in a liquid fund is if it receives redemptions that overwhelm it and the strategy ends up having to gate or close down for a period of time, which means that during that period, you can't get your cash back. Thankfully, those instances are rare, and often the impact of running too much money and having an illiquid portfolio are more hidden. So they could be that your fund has to pay more to trade. So the market impact costs are higher because you're a bigger fish in that pond. If that's not happening, it could also be because the strategy or the underlying strategy of the fund is changing and there's some style drift in there. So the manager is actually not trading how they want to. They're kind of maybe holding on to the more illiquid names because they know they can't sell them, and selling the more liquid names, or vice versa. If they get a huge inflow, they can't buy some of those less liquid names that maybe have driven some returns in the past. So again, that will kind of eat into your future expected return.
So I was going to ask you for a recent example. I feel we can't discuss liquidity without mentioning Woodford Equity Income.
Yeah, I mean, that's one of the instances that led to a lot of developments in our model, because it was something that we were well aware of, because it kind of just flagged up at all the stages that we have. So on a pro rata level, like, it was off the charts. Like, there was just such an illiquid tail of stocks and holdings within that fund, that it was by far the least liquid. From a waterfall standpoint, even in like a fire sale scenario, it had very little liquidity at the top that it could actually access. So when it did get a big redemption, it couldn't even meet that redemption without having to dig into like the really, really illiquid stuff at the bottom. And then just from an ownership perspective, it owned kind of almost 20% of a ridiculous amount of companies, which meant that when they came to sell, the market knew they were trying to sell. The market knew they were in a jam. So the kind of the prices that they were being offered to sell those stocks were way, way lower than what the market value would be or had been. And that's what led to some of the huge dislocations in performance you saw with that strategy.
So how do I avoid that sort of scenario as an investor? How do I assess liquidity?
Yeah, I mean, read our research. I know that sounds glib, but it's very difficult to find out the liquidity position of a fund at an individual level, because each manager does their own analysis. And when we were building this model, we looked at all the regulatory guidance out there, and it's very, very broad, and it really allows funds to put their fund in as good a light as they want. So going back to the Woodford scenario, we were talking to Woodford, talking to his risk and compliance teams. They were saying they were fine. They're running their own assessments, which were all in the boundaries of what the regulators say, and they were saying they were fine. We didn't think that they were, and that's why we developed this. We developed our own model so that we could run it across every strategy and be able to identify the funds that look problematic. And if your fund looks problematic, then our analysts will do a much deeper dive into what's actually going on there and what might be causing it. And then that ultimately affects the final rating that we give the fund. And you'll also be able to see commentary on that in the reports that we write.
Tom, thank you so much for your time. For Morningstar, I'm Holly Black.
That does it for this week's Investing Insights podcast from Morningstar. We hope you have enjoyed our program, and we welcome your feedback. Please send your comments and questions to podcast@morningstar.com. From everyone here at Morningstar, thanks for listening. This recording is for informational purposes only and should not be considered investment advice. Opinions expressed are as of the date of recording. Such opinions are subject to change. The views and opinions of guests on this program are not necessarily those of Morningstar Inc. and its affiliates. Morningstar and its affiliates are not affiliated with this guest or his or her business affiliates unless otherwise stated. Morningstar does not guarantee the accuracy or the completeness of the data presented herein. The podcast is for informational purposes only and should not be considered tax advice. Please consult a tax and/or financial professional for advice specific to your individual circumstances. Morningstar Research Services, LLC is a subsidiary of Morningstar Inc. and is registered with and governed by the U.S. Securities and Exchange Commission. Morningstar Research Services shall not be responsible for any trading decisions, damages, or other losses resulting from or related to the information, data analysis, or opinions or their use. Past performance is not a guarantee of future results. All investments are subject to investment risk, including possible loss of principal. Individuals should seriously consider if an investment is suitable for them by referencing their own financial position, investment objectives, and risk profile before making any investment decision.